The world economy is facing a number of challenging issues at the moment. For example, what's happening to the budget deficit both in America and in Europe? Is there enough growth in America to keep the recovery going? Is there too much growth in China leading to excessive inflation? Commodity prices and the oil price have been very high, leading to concerns about inflation in other countries as well. Here in Australia, there are questions about how much further interest rates will go up and what's happening to the Australian dollar, which is now trading at levels not seen for more than 30 years. These are some of the issues that we'll talk about in this update. The budget positions in countries like America and Europe have attracted a lot of attention recently. In America, there's been an argument between Congress and the President about lifting the debt ceiling. This is something that happens on a regular basis, and although it attracts a lot of attention at the time, the debt ceiling always gets lifted. Nevertheless, the Americans still have a lot of work to do to improve their fiscal position, and it will take some time to do so. Over in Europe, with countries like Portugal, Ireland, Spain and Greece, the problem is much more serious. The ability of these nations to service their national debt is virtually gone. Without support from strong countries like Germany and France within the Eurozone, there is little ability for these countries to work their way out. The political debate going on about solving this question is causing turmoil in the markets from time to time, but it will be resolved. Part of that solution will be a weaker euro and higher interest rates in that part of the world than we would otherwise have seen. There has been a lot of attention focused on China in recent years. At the moment, the question going through the mind of financial market participants is just how strong the Chinese economy is and how much longer it can maintain that strength. Inflation has been rising, and the government there has been tightening monetary policy to try and restrain that inflation. This is causing concerns about ongoing strength of commodity prices, which obviously are of benefit to countries like Australia. Some of the increase in inflation we're seeing is caused by transitory increases in food prices, but on the whole, China has an interest in maintaining a reasonable pace of growth in order to deliver the structural development they need over the coming years. One of the features of the world economy and financial markets in recent times has been the strength of commodity prices, not just oil, but also a wide range of other commodity prices, including many foodstuffs. This has been caused partly by crop failures and floods in various producing countries, and also by some speculative activity among global investors. However, underpinning these rising commodity prices has also been a certain strength in many economies around the world, including in the emerging nations. As we move through the business cycle, and these countries are already instituting tighter policies to slow down their economies and dampen inflation, so some of the pressure on commodity prices is expected to ease. This will mean, amongst other things, that some of the strength and support that we've seen for the Australian dollar will tend to dissipate. We've been lucky to have a stronger economy than many other countries coming out of the GFC. As a result of this, our interest rates have been higher than a number of other countries, and there is still pressure on the Reserve Bank to lift interest rates in response to inflation. As a result of this, the exchange rate has been very high and has been above parity with the US dollar for the first time in 30 years. Strong commodity prices have also helped do that. Right now, the economy is going through a shorter, softer patch, so over the rest of the year, the upward pressure on interest rates may be less than previously expected. Nevertheless, the bias is still there for higher rates, and until the US economy reaches a point where the Federal Reserve can be comfortable about tightening interest rates there, it is likely that the US dollar will remain weak and the Australian dollar will remain strong. Here in Australia, we've been fortunate to have a much better path out of the GFC than many other countries. Our unemployment rate is very low and the inflation rate is still reasonably modest. Nevertheless, we do have a budget deficit that needs to be rectified, and the Reserve Bank is still concerned about inflationary pressure emerging over the rest of this year and into next year. On the one hand, the strength of the currency is helping to moderate those inflationary pressures, and the higher interest rates here than elsewhere in the world is contributing to that as well. Right now, the economy is moving through a softer patch. Activity and employment growth are slowing down a bit, and capacity utilisation in the manufacturing sector is reasonably modest. Nevertheless, the bank is still concerned that growth will pick up over the balance of this year and into next year, and that inflationary risks are not yet past. In this environment, there is still a chance that the Reserve Bank will lift interest rates further, but perhaps by not as much as had been previously expected. In recent months, we've seen considerable turbulence in the global financial markets, caused not just by the economic events that I've been talking about, but also by natural disasters, such as the terrible earthquake and tsunami in Japan. The portfolios we design and manage for you are intended to operate independently as much as possible from such disturbances. By selecting strong investment managers within the portfolios and building them in a well-diversified fashion, we are able to deliver a consistent stream of returns which is not susceptible to violent fluctuations such as we might see in equity markets or currency markets from time to time. The performance we've delivered in recent months is testament to this.